Welcome to the Oil Minute, creating unlimited value in the oil patch. Today we're going to talk about a new refinery, reactions or analysis, floating storage, and DAPL. So a new refinery. So North Dakota Supreme Court apparently cleared up the way for the Davis refinery, I think owned by Meridian, to complete construction. I couldn't find a timeline when they estimate to start, but the refinery would be 50,000 barrels a day, and it's in the heart of North Dakota, which is in the Williston Basin in the Bakken play. So to analyze if the refinery makes sense, just on a very basic fundamental level, not getting into the nitty-gritty finance, debt, all that stuff, it's just to basically look at the crude and the product side. So on the crude side, that obviously is a cost to the refinery, you want to look at, okay, well, where are they going to source the crude? So pretty obviously they're looking to source Bakken crude because it's basically right on top of it. And this makes sense. As a refinery, you do want to be in a region that has cheap access to crude, preferably in a region where there's too much crude for the local refineries to handle, and that would be surplus crude, or as we say, long crude. They're long crude. This is one of the reasons why the West Canadian refineries have an advantage, because they're sitting on top of all that West Canadian heavy oil, but there's so much oil up there that it needs to clear down to the Gulf Coast, and that obviously costs a lot, so they are able to capture that sort of difference in price as an advantage on the crude cost side. So that makes sense for this refinery to be in the Bakken on the crude side. On the product side, I guess it makes sense. I'm not sure. I'd have to do the calculations because 50,000 barrels a day, if it's running full tilt, say at 100%, which is not sustainable, but it's probably at least 20, 25,000 barrels a day of gasoline. If that can all be consumed in the local market, well, then that's a win. Just the only risk is if they have certain products that they make that has to go outside of their local market, well, they're going to need to discount their price to clear out those products. So, this is one of the big reasons that we haven't seen new refineries in the U.S. for quite some time, is because, well, now the U.S. is a major exporter of petroleum products, gasoline, diesel, jet fuel, all of that. So, if we're a major exporter, even though we have pretty good crude access, that means that we're going to have to discount our prices on an overall level to clear out to farther away markets. So, especially in the Atlantic Basin, which seems to be having a surplus gasoline in the long term. So, reactions or fundamentals? Reactions or analysis? So, my expertise is on the fundamental side, right? So that's supply, demand, pricing, differentials. But if you look at Twitter, if you look at the news, a lot of times you'll just search oil in Google on the news, and you'll see oil's up on weak dollar, or oil's down on demand concerns, or oil's up on rising Middle East tensions. It seems to be basically a program that you can predict. It's Middle East tensions, it's weak dollar, it's demand, it's supply, and obviously that's directionally accurate a lot of times, but as some of my friends in the industry point out to me, that the Brent contract is so highly financialized. And there's so much going on in the paper market on the financial side, not even just the physical side. So a lot of the trading activity is just on the paper market, not ultimately centered on physical delivery of crude. So that's where you can kind of get some disconnects between the price and the fundamentals. I've always just seeded that it's almost impossible to forecast Brent. It's almost impossible to forecast the price of oil at any given time. What you can do on the fundamental side is you can look at the supply-demand imbalances, and you can price everything off of Brent, which is why oil and gas is so interesting, because it seems as if everything cascades off of Brent, with maybe the exception of some natural gas tied prices. So if everything ties off of Brent, well, even if Brent goes up or Brent goes down, you can still forecast those differentials. For example, the gasoline crack, or the difference between one crude over the other, just based off of the refining value, supply-demand fundamentals. So kind of the takeaway is, aside from that daily price noise, the fundamentals are going to drive the differentials, but the price is almost anybody's guess on any given day what's going to happen, because there's about infinite variables. Floating storage. So according to Bloomberg, there seems to be a heightened interest in floating storage for diesel. This should be no surprise, because we've talked about on this podcast, diesel stocks in this country are about 43 million barrels higher year on year. There's a backlog of storage also in Europe, and Europe's key because European cars mostly run on diesel as opposed to gasoline in the US. So if you have an oversupply, well, you need to find a place to put that diesel and obviously in storage tanks. But if storage tanks begin to fill up, well, then you need to look for an alternate mechanism of storage, which ultimately is going to be ships. So that's where the term floating storage comes from. This makes sense. According to the article, Glencore, Vitol, Trafigura have been interested in taking ordering some vessels to maybe store diesel in, which makes sense. I just think that an interesting second order effect of this will be the effect on the freight rate for other clean products. So a clean product tanker can take diesel, but it can also take naphtha, gasoline, jet, kerosene, gas oil. And if supply of those clean product tankers is taken off the market because it's storing diesel somewhere on the ocean, well, then that's going to constrain the supply of those vessels, ultimately driving up the freight rate. And the way that affects the fundamentals is you would expect the inter-region price differentials between certain products to widen out to account for that higher freight cost. Okay, DAPL, Dakota Access Pipeline. So apparently Dakota Access Pipeline, according to oilprice.com, I believe, can remain open through the end of the year. This is, up in litigation again. Some federal judge in July ordered it shut, which totally surprised the market. I mean, it was running at full tilt, already been through all these permits, and a few years ago, lots of protests, and the Trump administration kind of pushed that through. So Energy Transfer appealed, and then apparently a panel of the court said you can remain open. Don't exactly know how all this works. The important thing is where is this going to go? So I predict that it won't shut. It just seems that would open up so much precedent to shut down existing infrastructure that it would open up just this crazy slippery slope, and it just might be wild. So what I think is more likely is it'll continue to face challenges. Remember, we've talked about in this podcast that the opponents to pipelines, opponents to crude oil infrastructure, and even product infrastructure seem to have infinite scope, right? So this had to do with some fine print in the permitting or crossing a river, and we mentioned Keystone XL having to do with some species. There seems to be infinite scope. So I think this is one of the reasons that you've seen the administration try to push for streamlining. I don't exactly know how they're going to do that. I haven't looked into the details, but it definitely makes sense in the sense that the infinite scope of a pipeline, opponents to pipeline development, just seems to raise the cost dramatically over time. And we saw this with the TMX, and ultimately Kinder Morgan sold it to the government of Canada, kind of washed their hands of it. Until some of this permitting and stuff is cleared up on the interstate infrastructure development level, I think we'll continue to see appeals, challenges, endless litigation. But I don't think DAPL is going to be shut because it was already running, and I just think the precedent would be too much. But I'm not a lawyer. That's all I had for today. I'm Zachary Rogers, and this has been the Oil Minute.